Welcome to the Page One Podcast, a podcast featuring a variety of guests and thought leaders on topics ranging from digital marketing, sales channel strategies, influencer marketing, best-in-class product launches, and all the details about how to accelerate sales. Now, here's your host, Luke Peters.
Thanks for joining us on the Page One Podcast. I'm your host, Luke Peters, CEO of New Era Appliances and Retail Band Digital Strategy Agency. This episode is sponsored by Retail Band, where we can give business owners a blueprint on how to grow their digital sales, either direct to consumer or via channels like Home Depot, Wayfair, Walmart, and Amazon. To learn more, find me on LinkedIn or email me at luke@retailband.com. In this episode, you're going to learn from Roland Frasier on why buying companies is better than building, how to find and buy companies, and then how to exit your business. A little bit about Roland Frasier is co-founder and or principal of 5 different Inc. magazine fastest growing companies. He's a serial entrepreneur who's built 24 businesses with adjusted sales ranging from $3 million to under $4 billion. Currently CEO of All Channels Media and principal in Scalable.co, digitalmarketer.com, Traffic and Conversion Summit, Proxio, TrueConversion.com, War Room Mastermind, a bunch of other businesses. Roland's all over the place. His work includes infomercials with Guthrie Ranker, publishing deals with Simon & Schuster and Random House, shows with major hotels in the Las Vegas Strip, over 100 private and public offerings. His specialties are acquiring or partnering with entrepreneurs to scale business through acquisitions, strategic relationships, and marketing. And he lives in San Diego with his family. Roland, thanks for joining me on the Page One Podcast.
Hey, Lou, thanks for having me.
I hope I covered everything there in the intro.
Oh, man, it's just too much stuff. I sound like a sketchy guy. I don't trust it.
Yeah, I know. It's funny. Well, it's like you don't want to leave any of the important things out. So basically for the audience, Roland's got his hands in a lot of different companies. So yeah. All right, cool. So a little bit of background actually before I get into this, just so the audience knows, I attended one of Roland's in-person events. It really blew my mind. This was in San Diego at a beautiful place, by the way. And he talked about rolling up businesses, why it's better to buy than to build, how to find them, how to then exit and kind of act like in a way, kind of act like your own PE, where you're rolling these up and you're exiting, and then the numbers behind it and why that works better financially. So we're going to talk specifically about that because I know, in this period, coronavirus, a lot of successful companies are looking at that right now. They're looking at acquisitions. And I thought that would be great for the audience. So, but Roland, before we get started, I did mention a bunch of things. Is there like a simpler way to describe what you do so the audience gets a feel for what you do, or maybe some of the products you sell or services you sell?
Yeah, I think what you said at the end, that wrap up is pretty accurate. It doesn't really matter about the company to me terribly. There are areas that I tend to focus on now, just because I've got experience in them or they seem like they're appealing. But the whole process really is to be effectively to be your own investment banker, your own private equity firm, to acquire interest in companies that are already profitable, that are already going, to do so with a minimal outlay of your own cash, and then, with an eye towards growing them and scaling them up to exit.
Okay, cool. And then, what I found interesting is I think it seems like you're really efficient. You got your hands in a lot of companies, but it sounds like mostly as an investor. How many total direct employees do you have? Are most of them outsourced? Or just kind of like, how does your company stack look there?
Yeah, I don't have any direct reports that are mine. I have usually, I have some general managers or CEOs of companies that I wouldn't say they report to me as much as, I look at myself as a coach for any of the businesses that I have an interest in. And so that allows me not to be on any organizational chart, which means I don't have a job description, which means I don't have a job, which is kind of how I like it. So I get to take the things that I'm good at and share those things with other people to help guide them in the right directions, or hopefully the right directions when I'm working with the company.
Cool. And then you are, if I remember right, you're an attorney by training, right?
Yeah, I am a recovering accountant, a recovering attorney, a recovering securities investor. I've had a Series 7 license back in the day, and also real estate. So I have lots and lots of educational certification licensee kinds of things in my history, but not actively doing any of those things right now.
Okay, great. And that's good. It gives kind of a baseline for everybody listening. And actually, I do have a real estate question later on, so we'll jump into that. And why don't we just start with the first idea here? Buying is better than building. Can you explain why?
Yeah, I think there's a lot of reasons. The biggest is that in terms of the effort that it takes to start a business up, it's a tremendous amount of effort because you're starting with a completely clean slate. So you don't have a product to start with. You don't have a group of customers to buy the product. You don't have the relationships with the suppliers who are going to help you create it, or with really anyone. You don't have prospects. So everything is as hard as it's ever going to be because you're literally starting with nothing when you start a company. That's the excitement and joy of a startup, but it's also the challenge. And so rather than having to create all of that and deal with the incredibly high failure rate, which is, depends on who you ask, but the stats I see say, about 70% of businesses fail in the first year and about 90%, over the first 10 years of being in business. And even the big companies that do venture capital that have all the smartest people that they can get on their staffs fail about 75% of the time. So with that super high failure rate and all the effort and expense is required to start up a company, I just think it's easier to find one that's already gone through that challenging period of getting going and is past the big risk of failure, and get one that's profitable, that already has customers, sales, product, employees, relationships, branding, all of those things that it can take a long time to build up. And the failure rate on acquisition statistically is only about 2% compared to 90% for those other companies. So I like those odds much, much better.
Perfect. That makes sense. And now for the entrepreneur who's they got a successful business, maybe they want to buy companies just because they want to have other assets, or they want outside of their current, or they want to roll it in. I know you spoke about this, in the conference, but it still is a difficult one. Where should they find these leads? What's the best place to find acquisition targets?
Yeah, I think if you've already got, and think about too, that it doesn't have to be that you're buying companies. It can be that you're buying assets, as you mentioned. So maybe you want to acquire just some particular asset that's going to help you with your existing business. So I look at really 7 major categories of acquisitions of either companies or assets. The first one that most people know about, and that's the most common, is just simply to look at who's your competition. Both your direct competition, people doing exactly what you do to the exact same target audience, and indirect competition, which might be doing the same thing you do to a different audience, to a different geographical location, or a substitute or replacement product, so that you're selling umbrellas, but somebody else is selling sunscreen. Those can be 2 products. One might be a substitute for the other. That's the first place that I would look. And so in there, you could think about buying an entire company, or you could think about buying a product that is being sold in a different market, or, that could be sold to yours. The next place then would be to look at media. And media would be anyone who's already aggregated the attention and eyeballs of your ideal customer profile. Whoever already has done the work of becoming a center of influence that has a lot of your ideal customer, those are assets that you can acquire. And that might be anything from a Facebook group or a YouTube channel or Instagram page to sites that are SEO'd, that rank on Google and the other search engines. It could be a podcast like this one that everybody's listening to, or a trade show, or even a complete company that has like a newsletter or a magazine or a show or something like that. Then the next category after that would be looking at who's got resources that you would be interested in having in your company. Who's got maybe even a team of people that would be good for you in your company? Like if you want to go into software development, but you don't know how, maybe you could just acquire a company that already has a software team, and you don't even care about the software that they've got. They just have a proven development team that could get things out, or an inside sales team, or a team of sales reps. Those would be things that you would consider. You can also do what they call acqui-hires, which is that you're acquiring another company to effectively hire the management team that's there. So that's another category. Then another category would be services that are already being sold to your ideal customer profile or to your existing company. Another category would be products that are already being sold that way. And Another would be your supply and distribution chain. So where are you getting your products made that you are selling? And how are you selling them? Are you selling them direct to the consumer yourself, or are you selling through maybe affiliates? You could acquire those affiliates, or through websites. You could acquire those websites. Whatever the distribution and manufacturing channel is for your, or chain is for your product or service, that makes sense to acquire up and down that. And then last but not least, intellectual property. Is there intellectual property that's out there? It could be a brand that would be comfortable or comforting and known to your audience that is acquirable. It could be a software as a service kind of thing. It could be a patent or copyright, trademark, all of those things. So I like looking around that grouping of 7 different major categories of assets and companies to start with, because I think they're the ones that are going to grow your business the fastest. If you think about, if we go back to that and say, okay, so let's look at each of those categories. What am I going to get from that? What I'm going to get from competitors is customers. What I'm going to get from media is leads. What I'm going to get from team and resources is infrastructure. What I'm going to get from products and services is the ability to expand my market. So that's going to give you more margin. Another margin increaser would be up and down the supply chain. You'll be able to get more of the margin because you're not giving it off to somebody else. And then intellectual property provides you with additional margin as well, in that you have more people that are going to come to you as a result of having that. So when you think about that, it's like I can build any business very quickly if I can get leads, customers, increased margin, increased team and resources. And that's what each of those 7 categories ultimately can provide.
Yeah. I mean, hopefully everybody can rewind that. There's a lot in there. And I'll simplify or zero in on one point just from the conference that I was at. I think you said something to the effect of, hey, look who you're writing your checks to right now. And, and those could be synergistic buys. They could be add-ons to your company. I think that's an easy process that everybody, can go through, any business owner that's listening right now. And, Roland, you talk about the different types of companies. What about the different sectors? What do you like right now? Or does anything stand out right now, October 2020? As far as obviously, digital media is always hot, but, part of some of the other ideas you had was, hey, there's a lot of baby boomers that are going to be getting out of their businesses, and there's going to be a lot of opportunity. And those usually are not going to be digital companies. What do you see right now? Anything stand out?
Yeah, in terms of industry, it doesn't matter a whole lot. To me, it's more about the things that I don't want than the things that I do. So let me start from that. I generally like to stay away from businesses that have very low margin. So, anything that has a historically low margin of, let's say, under 10%, that's not going to be appealing to me. So if you think about, probably the most famous would be supermarkets. They have, such like 1% margin, because there's really a lot of places to make errors there that are going to get you in trouble. And I want to have the ability to have some flexibility to try some things and make some mistakes. I also don't like heavily regulated industries because there's people that make money in all of these. Just for me, I'm a low friction person. So anything that has friction, to me, there's friction if there's not enough profitability. There's friction if there's governmental agencies that are looking over your shoulder and they're heavily, like the health industry, you've got to comply with HIPAA and all these other things, or financial services and that kind of thing. Even though those can be great companies for people, for me personally, I just want a simple business. I like Buffett, says I don't invest in any business I don't completely understand, and that's kept him out of tech. I actually like tech because I understand it. So I do like software. I do like e-commerce, except for the inventory component, and not one that's completely dependent on a single source for distribution like Amazon, because you're going to have a hard time acquiring Amazon. And I like e-learning. I like services businesses because inventories can be challenging. So unless there are really strong opportunities to shift the responsibility for financing inventory off of the company to either the manufacturer through a consignment type program or just-in-time inventory delivery program, or to the customer through pre-sales or some other deposit type mechanism, then I generally stay away from those types of businesses. And obviously with everything that's happened recently in the economy and in the world, the businesses that I see growing the fastest are not dependent on foot traffic. They are capable of operating whether people are able to visit the physical facility or not.
Yeah. And speaking of service businesses, I mean, they have their challenges too, right? Because a lot of them are all selling the same service. So it's hard to differentiate. We're talking about the non-SaaS businesses.
Mm-hmm.
Do you like them because they should have higher margins? It's funny because I know a lot of people that run them and they don't have high enough margins, right? But generally, like service business should have like 25% net profit margins or something, right?
Yep.
Is that what's appealing?
Yeah, it is exactly. And the thing is, the challenge with many service companies is that they are not providing a productized service. They're providing, a customized service. And so they're dealing with like an ad agency or a graphic design agency or a digital marketing agency that they don't have a product as much as they have a service. And so I like services that can be or have been turned into products so that they can be scaled. Because if you need to depend on the people who are providing the service to do a customized thing that they deliver to each customer every single time, it's very difficult to scale and operate at a larger volume, which you're going to need to do to be able to, to grow the company to the point where it's going to exit profitably. So that's something that's very important in that process for me as well.
And then, if you're acquiring these companies, I have a couple questions in here. The main question is like, how do you look to hire people to run these? But it sounds like, correct me if I'm wrong here, that you're able to run these passively, that you don't have to be the active day-to-day CEO. You have other people that are running these businesses. Can you kind of talk a little bit about that and like structure and, just get, business owners right now dreaming or thinking about a different way of how they could be living their lives and running their business?
Yeah, I think it works out to about 9 different ways that you can do this as far as not running it yourself. So number one, I generally I like to look to the smart people that have already figured things out so I don't have to. And one of the things that you see very common in private equity firms that are buying companies is that they don't buy 100% of a company. They'll typically buy, on average, I'd say 80% is the most common, but maybe they'll buy 90, maybe they'll buy 70. They typically always want control, and they typically, want to have at least 70%. So I like that model. And if you don't acquire 100% of the company, then you are leaving in the management who is already there. Now, people say, yeah, but why would somebody sell their company and stay? I mean, it happens all the time. And the reason is that they believe that with the resources that you're going to bring as part of the acquisition, that they will be able to have an exit later with their remaining 10, 20, 30% that might be even greater than what they get on the initial acquisition when you buy control. So the story as an acquirer that you want to tell is, you want it to be true, obviously, is that, hey, I'm coming in and I'm going to acquire control of this, and then we're going to do some things to professionalize this business and package it for sale and then go through the process of finding a buyer. And we're looking to have a significant increase in the value of the business on exit, and typically that's at least a 5x, and hopefully it's a 7 or 8, or more X on the business. So here's what's cool. If I buy the business from you now and I buy 80% and you keep 20, but we 5x the business, that means that you'll get basically the full value of the business that you're selling today almost twice, because that 20% multiplied by 5 equals 100. So that can be a significant and frequently bigger exit for you once we get this thing professionalized and ready for sale than it would be if you were just to sell the whole thing right now. So that's why you should stay. Now, how you should stay might be in one of several ways. Maybe so I'll just go through kind of a few scenarios. So you've got the founder CEO stays and they stay as an employee. The founder CEO stays as a minority owner, which is the scenario I talked about a minute ago. The founder CEO stays as a consultant, and not an employee, but a consultant for some period of time under contract. Then you get to, okay, well, maybe that person isn't going to stay. So who is the person who is currently running the company? Because very often when a founder is thinking about selling the company, they've already got somebody else who's running it, and they've kind of stepped away from the helm a little bit. So who is that person that's running the company right now? That might be a general manager in a smaller company, or it might be a COO in a larger company. And then if I don't have that person, I'm going to say, okay, well, who is number 2, 3, or 4 down the line to the people who are running the company right now if they're going to exit and leave? Are those people who have the opportunity to step up into position of running the company? And so that gives me another group of people to look at. Then I can say, okay, well, if I can't find those people, then what about my network? Is there anybody that's out there in my network? If I can't find anybody in my network that has experience with that, then I'll say maybe we should acquire or partner with a competitor, because the competitor has the same skills. So then I can go to the competitor and say, hey, I'm in the process of acquiring this company. We've been a competitor of yours for the last 12 years, and we're looking to exit. And if we work together, we can build a company that's stronger and going to exit for more money. I need an operator. How about if we do this? And I basically contribute my company, you contribute your company, you operate, I handle the exit process, and we work together to do this. And then you can go from there to, I need to talk to a recruiter or a search firm. And, then I guess the worst possible case would be that you're just running ads someplace. So there's a lot of places to go to find those people that can run the company.
Okay, cool. And Roland, you're a founder or owner with Digital Marketer. And that is kind of an inherent advantage, right? I mean, you have, at least in what I want you to tell me is if I'm right or wrong here, or maybe give me a different example. But so just so the audience knows, Digital Marketer, Traffic and Conversion Summit, you guys started that. And you in the company have a lot of digital expertise. And it seems like you're able to really leverage that on companies that are, they maybe have a good product or a service, but then they don't know how to rank or get eyeballs to the site, and you guys can leverage that. Are there examples where you've purchased companies or invested in them and where that wasn't an opportunity to provide upside and you had to just do it, with other skill sets or the old fashioned way? How much of an advantage has it been that you have the Digital Marketer, kind of as the framework?
It's really funny because you would think that it would provide a tremendous advantage. And certainly being good at marketing or sales is an advantage because that's what rings the cash register. But the truth is that if you ask me or my business partners in Digital Marketer to rank a page right now, we wouldn't know how to do it. If you ask us to run a Facebook ad with any level of skill beyond being able to click the obvious buttons, we wouldn't be able to do it. If you ask us to do really anything other than, I guess, writing copy, we're all decent copywriters. We're decent at creating offers. But those aren't the things that usually move the needle in terms of your skills, because those are readily available skills at any good digital marketing agency that's out there. So, and it's not the highest and best use of your time, because to me, the thing that gives us the biggest advantage is we're good at strategy. And if I could only pick one skill to have to be successful in business, it would be to be good at strategy, because those technical skills are hireable at really defined, not expensive market rates. Even if you might say, well, a good CMO is going to cost me 120, 150 grand a year. Okay, right? That's not that much money in a company that's generating 7 figures plus in profit. And so it really isn't the advantage that you might think it is.
That's a great answer. And talk about strategy. So when let's say you purchase a company, or you now are getting involved your first week, your first month, are you using any type of planning process, that gets all the strategies, goals, and vision together? Curious if you have anything written down there or what you like to use.
Yeah, we do. We have a system which, in our company, we have a company called scalable.co, and we have a strategic system. It's 3 primary components of strategy. Each of them has multiple components that go with them. And so we have a playbook that we run when we go into a company, as to the things we're going to address first, how we're going to do each of the things, who are the right people to put in place, et cetera.
And then is that you going in? Do you have like the same team that goes into all the different companies, or is it?
Yes.
Oh, okay, cool. And what types of people are they? Are they like a marketer or a salesperson, a finance person, or just what's the basic outline?
Yeah, it depends on the company. So, the one key thing that is consistent across every deal is the strategist, right? So and that's going to be me or one of my partners. And so then we'll go into the company and we'll assess where are the opportunities and where are the weaknesses in the company, and that'll determine who are we going to bring in. So then, and digital marketer, since you mentioned, it's a great example, right? So when I came into digital marketer several years ago, we didn't have like a really good salesperson. We didn't have a good events person. We didn't have a good sponsorship person. We didn't have a good CEO at the time, other than the people that were there who didn't want to stay in that position. So we didn't have a good finance person. So I brought all of those people in through relationships that I already had. And several of those people, 7 years later, are still there today. And so as I go into, there's a new company that I just met with today that I'll be investing in, and that will have some weaknesses, and I will bring in people that I know. So I know people who are good operators, people who are good marketers, and people who are good finance people. And so those are the three key categories that I would say that I have a pool of people who are well-versed and talented in those things. And depending on what they're doing at any given time, I'll reach out and bring those people in. And the goal is that they don't stay. Sometimes they do. Like a few of the people at Digital Marketer, 2 of them in particular, decided they wanted to stay for the full ride. But usually it's to get to the point where I just did this with a software company. So we brought in a temporary COO who is helping the company get its operations in order, and then they'll be moving on. And part of their job is to find a COO who will be the permanent person for that position. So that part depends. But the one consistent thing throughout everything is, to me, a strategist.
Yeah. Okay. That's super helpful. So let's talk about metrics. So the way, again, you're able to run these, obviously you're actively getting in there with the strategy, but what's appealing for a lot of people here, listening or on the sidelines is it's almost kind of in a passive way, right? You buy the companies, you roll them up, kind of like, I think you even talked about this, kind of like using your money to, buy the S&P or equities. You're just buying businesses, and it's kind of the same thing.
Yep.
What metrics, if any, are there? Of course, everybody's, look at a P&L, balance sheet, cash flow, but is there something special that you like to put together, dashboard or metrics or KPIs that you like to track your companies by?
Yeah, so we have a system for identifying what are the big 3 things that, what's the overarching goal for this next quarter, and what are the 3 things that are going to help us achieve that goal. And then we identify different KPIs based on what our quarterly goal is. So the things that will drive, so that you start with the goal, then you go, what are the 3 pillars that will help us achieve this goal? And then you say, what are the metrics, the 4 key metrics that will help us achieve these 3 pillars? And then what are the key initiatives, 8 or 9 of them under each of those 3 key pillars? So that gives us quite a bit of things to focus on. And then the dashboard is malleable. And so it's dynamic based on what are we after this quarter. So one quarter, we may be focused on increasing MRR, monthly recurring revenue, transactions, the number of transactions that we do, because we find that's a leading indicator for other things that are good. It might be a reduction of customer service hours in response time. And then one of them might, it's very often there's a growth goal on revenue. But then the next quarter, it might be the total number of packages shipped and, the total number of customers retained. So we're working on churn. And so that does change. We get a daily dashboard with the report of whatever the metrics that are important to us for the quarter to achieve our big goal for the quarter and what we call the big 3. And then that also becomes the basis for the weekly leadership meetings that we have of the people who are the heads of each division. And typically that's 5 to 7 people that are on the leadership team. And then each week, those people have a big 3 that drives them towards the attainment of each of the initiatives and pillars that are to achieve the big thing, tracked by metrics. And so in those meetings, we go over what's going on with the metrics. Are we on? Are we off? What's the gap? How are we going to fix it? And then we have a Kanban board that we use to track the movement of those key initiatives from ideation through completion. I hope that makes sense. I know it's a lot, but that's really the thing that drives us is not just to randomly pick a static set of KPIs that we're going to watch forever, but to say, the business is dynamic and our goals are dynamic on a quarterly basis. And so how do we decide what those are and then have KPIs that align with the attainment of those goals, and then have leadership focused on that, and then track the progress of how we're moving towards those over the quarter using the Kanban board.
No, it's perfect. It makes sense. I mean, we do it using a different method, but it breaks down very similar to what you're talking about. So that's perfect. Do you guys make a infographic about that? That'd be kind of cool to have.
We do have one for Scalable, which I think is launching next month.
Yeah, that'd be kind of cool to see that visually. But
the thing is that we really, we've been doing this for a while, and so we like to have it, as close. It's never perfect, but as close as perfect as possible before we say, hey, this is what we're doing, and share it with the world. We don't want to give them something that that we're not using actively in all our businesses and have tested quite a bit.
No, I hear. And for the audience, Roland comes off as like a really casual guy, mellow, having a great time. But I can tell you're very driven and you're very process oriented, and I think that probably you kind of joke around about your kind of legal background and stuff, but you are really process driven. A lot of business owners or investors are not. You seem to have like a process for everything, like that book you handed out.
Process and data.
Yeah,
absolutely.
There you go. So anyways, you handed us out like 400 slides. I think I'm still trying to finish that thing, but okay. Hey, I want to move on to a quick question on real estate. But before I did, for the audience, we kind of went through your kind of philosophy on, why buying's better than building, kind of, what types of things you can buy, talked a little bit about sectors and how to structure it and how to find people to run it, and talked about KPIs and a few other things. Before we leave that topic, was there anything else, that I might have missed?
No, I think you hit on a lot of great stuff. All
right, cool. So a lot of business owners also like real estate. Maybe they own their building or maybe they own other real estate. There's definitely some good, tax deductions and depreciation advantages for some people in that area. And I know you like real estate too. How do you compare the whole process of real estate investing versus buying a business? I ask this just because real estate, at least it seems more passive. It often needs less time. I mean, I guess you could say it has maybe less risk, right? Especially of going to zero, but it can have similar returns. Of course, businesses obviously kind of have the more exponential returns. Maybe that's the advantage you see in it, or I'd like to see your breakdown, of how you look at the two different investments.
Yeah, they are similar the way that I do them, and it kind of depends because there's lots of different ways to do each of these things. So if you're thinking about investing passively in a business, then an exchange traded fund, an index fund, is a great way to go, because then you're going to have a basket of stocks that you're investing in. To me, that's passive investing in business. And passive investing in real estate might be that you invest in a REIT, a real estate investment trust or fund, or something like that somebody else is doing. Or, you're buying a property and then you're going to have a rental, company handle the leasing of the property and you're renting it out. Although right now I know lots of people that are doing that are having a heck of a time because their tenants aren't required to pay by federal law. They can't kick them out.
Yep.
And I doubt they'll ever collect on the rents because these people don't have the money. They're experiencing the challenges of the current time. So it's kind of an interesting weakness in the model of people that thought they had their retirement set by having an apartment building or 2 or 7. And, right now it's how are they paying their mortgage when their tenants aren't paying? So I think that that's passive investing. But the real estate investors that I know more often are very active in the business, and they are not that they have to work in it every day, but if they're in the business of renting properties, they'll typically go in, find a property that's under market because it needs some work, or it's in an area that, is in the process of gentrification or something like that. And they'll invest, they'll ideally buy under market. They have a maximum allowable rehab allowance, right? So they'll say, I need to buy this at 20% or 30% off current market. So if market is, just because this is an easy number, if market's $1 million for a home in that market, I need to buy it for $800,000 or $700,000. And then I'm going to spend no more than $100,000 or $150,000 to fix it up. So all in, I'm still in 90% of market. So I could sell it, make, a 10% profit over a period of say 4 to 5 months. And then I'm going to either rent that out and have all of the, wonderful benefits of income depreciation, equity appreciation, and leverage, or I'm going to just flip the thing and make money. I know a lot of people that flip houses, and I like flipping houses. I'm actually on the phone in a house right now that we just put carpet down and are in the process of selling. So that's not exactly a passive business. It's not a business that requires 100% of your time. And buying companies and fixing them up effectively, rehabbing companies and flipping them, which is effectively, what we do as well. That's not completely passive because the business is the business of flipping. And that's something that is a big thing for me that I think is an insight that once you get it, changes how you think about everything in terms of business. And that is that the businesses that I own, they are my product. So I'm in the business of selling businesses, right? And I'm in the business of selling houses because I do invest in real estate too. So I'm not in the business of selling whatever my businesses sell. That's not my business. That's the business of the business. That's the job to focus on of the person that has the job title in that business. And the same thing is true with real estate, right? I'm not in the business of renting out real estate properties, even though I might have some properties that are rented. I'm in the business of looking at this portfolio of assets and saying, how do I acquire more assets under market that are likely to be able to be sold at or over the market price that I acquired them at? That's a huge mind shift as to what you should be focused on. So I don't care that the business sells coffee cups or wooden trays or lights or ice skates or whatever. I only care that the business has certain fundamentals in certain markets that are likely to achieve certain returns for me. And somebody else is going to be concerned about selling the thing that the business sells. I'm going to be thinking about, where do I get investors? How do I find my buyers? What other businesses should I be acquiring to tack onto this? And that's my focus. So I wouldn't call myself passive. I would just say I'm not working in or on any of those businesses. I'm working above them as the owner, with them occupying a portfolio slot in the overall investment portfolio that I've got.
That's a great explanation. I mean, it's truly like the investor instead of the operator, even though you get into the operations.
Yes. I mean, I think that to be a good investor, you got to know something about some part of the operations of the business. And, whether it's, whatever your skill is, if it's digital marketing, cool. Enough about marketing to say, hey, it doesn't seem like we're getting any leads now. We need more of those, right? But you don't have to know, what, should I use a Google GTM code that targets people that have consumed 50% of a video to 75%? That's not what we should be focused on. You're way in the weeds on that. You need to be looking at the field from the sky, not down in the weeds.
Wow. Well, that's awesome. Hey, before I move off that topic, though, I'm sure there's reasons you like both of them, but do you favor one over the other, real estate versus buying and acquiring businesses?
Not really, because I think businesses are really interesting because I like all of the levers that can be pulled. I think there are a lot more levers to pull for value with business, and I think there's a lot more upside in businesses than there is in real estate. But I love real estate because I like design and decor and moving walls around, and I like deals. So both real estate and business offers the ability to look for deals and, find hidden value and create, both of them allow you to exercise your creative muscles. So I don't think you have to choose, though. I mean, I think that, the business stuff that we do allows us to do real estate stuff, and the real estate stuff we do allows us to do business stuff. So I think you can do both if you want to.
For sure, 100%. And like you said, real estate is just fun. And
it is. Yeah, both of them.
Yeah. Well, listen, I really enjoyed having you on the podcast. Before I let you go, is there a favorite book that you like, or, maybe a business leader that you follow? Curious if you get inspiration from either one.
Yeah, I think in terms of books, just to give one that I think is really, really fantastic, but doesn't get referred a lot. There's a great book called Black Box Thinking. And it was on Richard Branson's. I interviewed him last year at our big Traffic and Conversion Summit event. And in prepping for the interview, I always look and find out as much as I can about somebody. And he had a list of like 63 books, that were his favorite books of all time. And so I read most of them prior to the interview. And that one was really full of fresh thoughts and interesting things. So I would highly recommend that book. And then in terms of people that I find to be, if I was going to pick one super eye-opening, inspirational kind of person to follow that you can get lots of breakthroughs if you dig in, would be Charlie Munger, who is Warren Buffett's business partner at Berkshire Hathaway.
Awesome. Yeah, I have what's the book that he wrote?
Old Charlie's Almanac.
Yeah, I got to go through that. I have that at the house. I've paged through a little bit of it. Cool.
Yeah, great stuff.
Well, listen, thanks again for being on the show. How can listeners find more about you or learn about you?
Sure. Thank you for having me. I really appreciate the opportunity to share. The best places, if you're a podcast person, I have a podcast called Business Lunch that is available on all the podcasty places. Also, I've got a business challenge that I've been doing, a 5-day challenge on how to identify businesses to acquire for no money out of pocket. That's one thing we didn't talk about was, how do you acquire these businesses and pay for them? Yep. You don't need a ton of money to do it. Most of the time, we're acquiring businesses using the assets of the business itself. And that is a 5-day challenge that's available at getepicchallenge.com. And then I'm on social everywhere /Roland Frasier.
All right, cool. And we'll put that in the show notes. And I'm a listener of the podcast, so definitely check it out, audience, Business Lunch. And we'll put the link to the 5-day challenge in there as well. And thanks again, Roland. I want to thank everybody else for listening to this episode of the Page One podcast sponsored by Retail Band. If you are seeking to improve your digital sales, Home Depot, Wayfair, any of those channels like Amazon and the other large channels, go ahead and find me on LinkedIn or email me at luke@retailband.com. And I hope you all enjoyed the interview today. Really appreciate reviews on iTunes and hope you join us for the next interview. Take care.
Thanks for listening to the Page One podcast with Luke Peters. If you enjoyed this episode, please help us out by leaving us a rating on iTunes. Want to double your online sales? Check out www.retailband.com. And don't forget to join us next week with our next amazing guest.